We'll quiz Ms. Anshula Kant. She joins in right now to talk about the numbers and the outlook ahead. Ms. Kant, thank you so much for taking the time out and speaking to us at Bloomberg Quint. People would look at this as a glass half full or a glass half empty. There were one-time gains which led to the numbers looking okay, but by and large, asset quality improved, slippages under control as well. How do you choose to look at the numbers?
No, I would definitely look at it as a glass half full and getting to the glass full actually stage. Because, if you go above the operating profit. If you look at our net interest income for quarter 2 over quarter 2, it has grown by 12.5%. For the half year, it has grown by 18%. That is the crux of our, earnings upside that we will continue to get in the future. The costs are very well under control. Overheads are extremely well under control. Staff expenses are elevated because of, the gratuity one-time increase and plus base revision that we are doing. That will also start to taper off in the coming months. Fee income again is looking flat, but it is because we've reduced our service charges on minimum balances over the last few months. So basically, if you look at the operating performance, it's really on the upswing. In terms of, if you want to look at it, yes, one time again we did get from the PSPL and general insurance. But the fact is we also had 1,700 crores of mark-to-market provision during the quarter for yields, GSEC yields. So, that is something now we are sitting on close to 16 to 17,000 crores of mark-to-market provisions, and yields start to come off. I think going forward we will get some upside there also. On the asset quality front, as you clearly, I was just hearing into your commentary, it has started to improve and the signs are now very clearly visible. So we are fairly hopeful of the coming 6 months in this year, and I think from next financial year onwards, it will be a much more stable performance. Interesting.
Ms. Kant, before we get to the internals as well, just a couple of issues which the street would really want to know about. On this NBFC a bit as well, you've bought about 5,200 crores of portfolios. I heard the chairman say that there is a probability of additional 15,000 crores, if I'm not wrong, in the pipeline and should be done by March, April. Are they happening at very favorable rates? And are these slightly sketchy ones, or are these the better quality ones that are coming at a more reasonable price to a premier bank like SBI?
So, we have our internal risk appetite policies for portfolio purchases, and these are coming in as per the risk appetite we already have in place. We are not, loosening up the controls there at all. And the pricing is good pricing. We are not going overboard. We don't want to skim the customer, but yes, it's at good pricing.
Okay, just the other elephant in the room would be power. Now there is, of course, it's a moving situation. We don't quite know how it will shape up because of the recent ruling as well. But how do you expect the recoveries from that space to shape up over the next couple of quarters, Ms. Kant?
Within this financial year, we are expecting, or rather hoping, to resolve at least 4 or 5 cases outside NCLT. Frankly, of the 30-odd stress power cases that we have, most of them have already been filed under NCLT. 11 have actually been admitted. But because there is a stay, we are continuing our efforts outside the NCLT process, and we hope at least 3 or 4 should get resolved. Typically, we have a provision of about 40%. What we are seeing is that we would end up with a haircut of, or rather recovery of about 50-odd%. So maybe another 10% on the 32,000 crores of NPAs that we have in this sector.
Okay.
Is what we will need to do.
Okay. A word, Ms. Kant, on, broadly you don't need to really say because the numbers spoke for themselves, but the asset quality and the slippages, I think they showed, at least the asset quality showed a meaningful uptick in this quarter. Do you expect this to be a trending situation, or do you expect stability at these percentages for the near term?
I think it should get better because if you, break up the slippages, if you look at the corporate slippages, they were only at about 3,000 odd crores out of this total 10,700-800 crores. The SME slippages will definitely come off. Agri slippages also we've typically seen in the second half of the year are better because, the sugar crops, the cotton crops, they all come in the second half of the year, the realizables for the farmers. So recoveries are better in the second half of the year. So corporate slippages having stabilized, I think that is the big one for us.
Okay, and I mean, for the good news, as people would like to look at it, is that for the second consecutive quarter, the overall total NPA addition was lower than what the number was in Q4. Now, again, do you expect this to continuously keep on getting lower as the quarters come by?
We have a watch list today of about 20-odd thousand crores. We don't expect most of that, all of that watch list to slip. So we do expect that the corporate slippages have stabilized and retail slippages will improve from here on. So I think things should look better from here.
Okay. Last couple of questions. The NIMs, and I think if I just look at the domestic NIM, it improved ever so marginally if I adjust it for the interest income booked on the NCLT resolutions. Core OPEX growth was kept under tight leash as well. How do you expect the next couple of quarters to look on this front, and what do you expect the NIMs to look like over the next couple of quarters?
Clearly, margins are on an uptrend. In any case, when there is an upward interest rate cycle, margins tend to improve. And we are expecting and we are seeing as we speak resolutions happening. Some of the resolutions have already happened in October itself, which will give an upside. So I think net interest margin from here on will get better. I think year end we should see anything around 2.9 or 2.85, upwards of this area where we are.
Interesting. Ms. Kant, one final question really. NBFC after NBFC that we speak to have seeded that for the last few years, the growth that they took away from some of the PSU banks might go back to the corporate-facing banks, not necessarily PSUs, but corporate-facing banks. Do you see this trend developing materially over the next couple of quarters, and then a share of, say, a very well-placed bank like SBI only improving materially on the businesses that the PSU and the corporate-facing banks lost to NBFCs over the last 5-6 years?
I wouldn't like to actually give a sweeping statement like that, but definitely the opportunity is there. But you must remember that our risk appetite and our policies for taking on new credit may be a little different from NBFC. So in that space, we are very confident that we'll continue to improve. Whatever kind of retail credit that you see, we largely lend to salaried owners, salaried class people. I'm not so sure whether housing finance companies, that is a target group that they are targeting. But definitely as, their offtake slows down, we will pick up some of it. But I don't think it will be a big, major chunk that will come to us. Clearly because of the discernment in what we would like to actually book.
Okay. Fair call. Ms. Kant, appreciate you taking the time out and joining us today and giving us your thoughts. Thanks so much, and festive greetings to you and the entire team at SBI.
Thank you, and happy Diwali to all of you.
Thank you so much.